The stock market is a platform where buyers and sellers come together to trade shares of publicly listed companies. It is also referred to as the equity market or the share market. The stock market provides a mechanism for companies to raise capital by selling ownership stakes, shares, to investors. In India, the major stock exchanges are the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. These exchanges facilitate trading of stocks, derivatives, and other financial instruments. How does the stock market work in India? Listed companies looking to raise capital offer their shares to the public through an initial public offering, IPO. After an IPO, the company's shares become listed on the stock exchange, and investors can buy or sell these shares. Stock exchanges, the BSE and NSE are the two primary stock exchanges in India. They provide the trading platform where buyers and sellers execute their trades. These exchanges ensure fair and transparent trading by maintaining strict regulations. Stockbrokers, to trade in the stock market, individual investors need to go through a registered stockbroker. Stockbrokers are intermediaries who execute trades on behalf of their clients. They have access to the stock exchange and provide trading platforms to investors. Trading in the Indian stock market takes place through electronic platforms. Investors can place buy or sell orders through their stockbrokers. The exchanges match buy and sell orders and execute trades at the prevailing market prices. Indices, the stock market indices, such as the BSE Sensex and NSE Nifty, represent the overall performance of the market or specific sectors. These indices track the prices of a basket of selected stocks and provide a benchmark to assess the market's performance. In India, the Securities and Exchange Board of India, SEBI, is the regulatory authority that oversees the functioning of the stock market. SEBI regulates and supervises stock exchanges, intermediaries, and listed companies to protect investors' interests and maintain market integrity. Investor protection. To ensure investor protection, various rules and regulations are in place. These include disclosure requirements by listed companies, rules on insider trading, prohibition of fraudulent practices, and investor grievance redressal mechanisms. Investors are individuals or institutions who buy and hold shares of companies for the purpose of long-term growth and potential dividends. Traders are individuals or institutions who engage in short-term buying and selling of stocks to profit from price fluctuations. They aim to take advantage of market trends, news, and technical analysis. Brokers act as intermediaries between buyers and sellers in the stock market. They execute trades on behalf of their clients and provide research, advice, and other related services. Market makers are entities that ensure there is liquidity in the market by continuously buying and selling shares. They provide quotes for buying and selling stocks, facilitating smooth trading. Regulatory bodies like the Securities and Exchange Board of India, SEBI, oversee and regulate the stock market to ensure fair practices, transparency, and investor protection. Trading mechanisms. Primary market. In the primary market, companies raise capital by issuing new shares through an IPO. Investors can subscribe to these shares at the offer price. This is the initial sale of shares to the public, and it helps companies raise funds for expansion, research, and other purposes. Secondary market. The secondary market is where previously issued shares are traded among investors. This is where most stock market transactions take place. Investors can buy or sell shares at prevailing market prices through stock exchanges like the BSE and NSE. Order types. Market order. A market order is an instruction to buy or sell a stock at the prevailing market price. The trade is executed as soon as possible at the best available price. Limit order. A limit order allows investors to specify the maximum price they are willing to pay to buy a stock or the minimum price they are willing to accept to sell a stock. The order is executed only when the market price reaches the specified limit. Stop order. A stop order is an instruction to buy or sell a stock when the market price reaches a specified level. It is commonly used to limit losses or protect profits. BSE Sensex. The BSE Sensex is the benchmark index of the Bombay Stock Exchange. It comprises 30 large and well-established companies representing various sectors of the Indian economy. NSE Nifty. The NSE Nifty, or Nifty 50, is the benchmark index of the National Stock Exchange. list of 50 actively traded stocks representing different sectors. Trading timings. The regular trading hours for the Indian stock market are as follows. Pre-opening session, 9 am to 9:15 am. Normal trading session, 9:15 am to 3:30 pm. Closing session, 3:30 pm to 3:40 pm. Post-closing session, 3:40 pm to 4 pm. Clearing and settlement. The clearing and settlement process ensures the smooth completion of trades in the stock market. It involves verifying trades, transferring ownership of shares, and settling the funds between buyers and sellers. Clearing corporations, such as the National Securities Clearing Corporation, NSCC, ensure the settlement of trades and manage risk through mechanisms like margin requirements and trade guarantee funds. This information provides a broader understanding of the stock market in India. However, the stock market is a vast subject, and there are numerous intricacies and details that can be explored further. It's advisable to consult authoritative sources, books, or seek advice from financial professionals to gain a comprehensive understanding.